Hey YouTube, today we're going to go over how to include a probabilistic analysis in your trading. The motivation behind this video comes from the fact that none of us can get all of our trades right, and in order to be profitable in the long run, we need to know that the odds are in our favor. After this video, you should be able to calculate the long-term profitability of your strategies probabilistically and be able to rank your strategies based on profitability. So let's dive in. The first thing you need to know is your odds. Odds is simply how much you expect to make by risking 1 rupee or whatever currency you're trading in. The formula for calculating your odds is simply the amount you expect to make on a trade divided by the amount you expect to lose on a trade, which can be simplified to expected profit over stop loss. Now, if your strategy has a 1:1 odds, do you know for sure if it's profitable?
No. Denied.
No strategy can be declared profitable until you know the probability of profit. Probability of profit is simply the proportion of times you make money as opposed to losing money and can be calculated by dividing the number of profitable trades by the number of total trades. If you have a 50% probability of profit, is your strategy for sure profitable?
No.
Nope.
Hells yes.
Good luck getting that 100%. A strategy is only profitable in the long run if the probability of profit is greater than the break-even. So what is the break-even? Break-even is simply the percentage of trades you need in your favor in order to break even, given the odds of your strategy. It can be simply computed by using the formula 1 divided by odds plus 1. Plugging in odds into this formula would give you a number between 0 and 1, which is the percentage of trades you'll need in your favor. Once you know your break-even, you can easily check if your strategy is profitable by comparing the break-even with the probability of profit, which you calculated in the last step. If your probability of profit is greater than the break-even, then your strategy is profitable. Else, it is just a really stupid way to burn cash. Hopefully by now, all the pieces are coming together and you're starting to get a sense of how the odds and the probability of profit work hand in hand with each other and how one really doesn't mean much without the other. Here's a table to do a quick lookup of what odds you need to break even given the probability of profit and vice versa. However, you can always use the formulas given in the previous slides to calculate them. It all really boils down to what kind of a trader you are. If you're a scalper with a high percentage of trades right, then you can work with odds which are very low. Whereas if you're a trend trader who only gets about 30 or 35% of his trades right, then you will need odds to be a lot higher. Now, let's do a couple of examples to see how these things are going to work in practice. The numbers chosen for the examples are completely arbitrary, but very realistic. Example 1. Let's assume a profit of 2,000, stop loss of 1,000, and a probability of profit of 50%, meaning you get half of your trades right. Using the formulas presented in the earlier slides, you're going to get odds of 2 and break even of 33%. Now, since 50% is greater than 33%, this strategy is profitable. Example 2. We're going to use the same setup as we did in the first one, just with different numbers. So in this case, our profit is 1,500, stop loss is 1,200, and the probability of profit is 42%. Using the formulas, we can calculate the odds of 1.25 and a break-even of about 44%. Now, since 42% is less than 44%, this strategy is not profitable. Now, we know how to make sure if your strategy is profitable or not. But given two profitable strategies, can you really tell which one is more profitable than the other, and by how much? To know for sure, we will have to consider the number of trades we can expect to make in a month or any other given time frame which makes sense for your given strategy. Picking the right time frame is all about the frequency you trade in. I would recommend picking a time frame in which you can expect to make about 50 trades. Why is this a recommendation? The central limit theorem proves that if you have more than 30 independent random variables, Their normalized sum tend towards a normal distribution,
blah blah blah.
but since trading doesn't agree with the normality assumptions as much, and given my personal experience, I would recommend 50, which seems to be a better choice. Once you have the number of trades in place, all that is left to do is take the expectation and calculate the expected profit and loss of the strategy. So, what is expectation? Expectation is simply the average profit you expect to earn per trade over the long run. Now, it would be nice to know which trades are going to be in your favor or not, but since there is no way of knowing which trades would end up in a profit and which ones would end up in a loss, the best we can do is to have an estimate of how much we can expect to make per trade. The expectation can simply be calculated by using the given formula. Probability of profit times expected profit plus 1 minus the probability of profit times the stop loss. Using the numbers from example 1 and the formula in the last slide, we can calculate the expectation or expected profit of 500 on each trade, meaning we can expect to make 500 on every trade in the long run from our strategy. To calculate the P&L, you can simply multiply the number of trades with the expectation. Now, we've already talked about how to pick your time frame, but make sure you use the same time frame when comparing two or more strategies. Now remember, this analysis is solely about profitability, and you can freely choose to keep trading the strategy with lower profitability for reasons like risk management or any of the 144 other reasons from the book. To summarize what we've learned, having just better odds or probability of success doesn't really mean you have a better strategy. So be wary of tipsters telling you that the risk reward of their strategies is 2:1 or even greater than that, and there's no way they can lose money. The odds don't really mean shit until you know the probability of success and vice versa. And in order to properly compare two or more strategies, you must calculate the expectation of each one and compare the expected P&L for a certain long enough time frame. Thank you guys so much for watching. Give the video a thumbs up if you liked the content and got something out of it. And don't forget to subscribe to stay updated on the upcoming videos. If you guys have any feedback or preference as to which of the following 3 videos would you like me to do first, please put it down in the comments section and I'll try my best. Until next time, happy trading.